Greetings to everybody. In this video, we are going to learn about fundamental analysis and in that economic analysis. So fundamental analysis, we mean it's a method of determining a stock's real or fair market value. Objectives of fundamental analysis: to identify the underpriced and overpriced securities in the market. Second objective is not to make any speculative profits. Third objective is to avoid risk of loss from buying overpriced stocks and selling underpriced stock. And finally, to beat the market, that is, buying an underpriced stock and earning some abnormal return on investment. So these are the objectives for carrying out the fundamental analysis before the investment decision. And this is a rule or recommendations made if the intrinsic value of the shares are more than the market price of the shares, it is recommended to buy the security. If the intrinsic value of the shares are less than the market value or market price, better to sell that security. And if the intrinsic value of the shares are equal to market price, no action can be taken. There are two approaches, top-down approach and bottom-up approach. In the top-down approach, we study the economy, we study the industry, and we study the company. And in the bottom approach, we study the individual companies into account. We analyze the basic fundamentals of companies, the profits, the earning per share, current ratios, or quick ratios, or some financials like. And then we move on to industry as a whole. We study the conditions of the industry, whether it's the right time that we should choose the industry. And finally, we go for a bigger analysis or bigger picture called economic analysis. So in the bottom approach, we go reverse, and it is always better to go for top-down approach. Now we will see economic analysis. Economic analysis is nothing but analyzing the economic conditions of the country. And here you can see the consumer price index of the country, the monsoon or rainfall, the how the agricultural sector is performing over the periods, the balance of payments in a country, how strong the infrastructure of the country is, how or what is the tax burden or tax structure in the country. So all these are factors which will have a bearing in the stock market. And these are the macroeconomic factors we have to consider before making the investment decision. Number one, gross domestic product. Number two, savings and investment. Number three, inflation. Number four, interest rate. Number five, budget, tax structure. Number seven, balance of payment. Number eight, monsoon and agriculture in the country. How the infrastructure facilities are developed in the country. What is the demographic factors which are prevailing in the country. Now we will see one by one. Gross domestic product. If you look at the meaning of gross GDP or gross domestic product, it is an aggregate value of goods and services produced in the country. Higher growth is favorable for the stock market, and GDP indicates the rate of growth of the economy. So it is good that we study at least 4 or 5 years GDP of the country to know what is the level of economy, what is the rate of growth of economy. That will give some clue whether it's the right time to enter into a stock market or not. So this is the India's GDP from 2013 to 2023, and 2022-21. The there was a sharp decline because it was a year of COVID-19. Now 2022 it started resuming, and again 2023 it it is little lower than. So this is analyzing or plotting the GDP into the line graph or bar chart will give us some idea, some hint on how the economy is moving in a particular country. So this will help us to make investment decision, and this will have a direct bearing in the Indian stock market. Savings and investment. How savings and investment pattern is or playing in the country. So savings will lead to corporate bodies. Savings will be directed towards corporate bodies, and savings will be invested in various assets like shares, debentures, mutual funds, real estate, and company deposits or bank deposits or post office deposits. And savings and investment pattern affect the stock market. If savings and investment pattern in the country is positive, and definitely there will be more inflow of money into the stock market. And this is a picture which states from the 2012 to and 2012 and again 2008, 17, 18. There was a sharp decline 2016, and it started rising from 17 to 18. Again there was a decline in 18 to 19, and there was a steep fall from 18, 19 to 21, and again it started rising. So this pattern will give us the money left in the domestic, money left among the people. Inflation. Inflation, we mean too much money chasing too few goods, and it directly affects the purchasing power of the investors or the common people. There are two in inflation. One is consumer price index inflation and wholesale price inflation index inflation. And inflation impacts interest rate, and that impacts valuations. This is a picture of India's rising inflation from 2012 to 2022. It is given, and both double wholesale price index and consumer price index is given, right? So more inflation will will be a negative sign, and for stock market mild inflation is always good. Interest rate. Interest rate affects its cost of financing to the firm. If the interest rates are high, it will be very costly for the firm to get the fund, and decrease in interest rate implies lower cost of finance to the firm and more profitability, and more money is available, and available of cheap money encourages speculation, and again that will see a rise in price of shares. So we will have a positive and negative impact on either increase in interest rate and decrease in interest rate. Budgets. There are three types of budgets that the country opts. One is deficit budget, one is surplus budget, and balanced budget. And for the country, favorable for stock market is balanced budget. Tax. How the tax structure of the country is, and more tax will lead to less money in the hands of individuals. Therefore, how the Reserve Bank of India, how the Ministry of Financing is giving the tax structure will affect the purchasing power or money available in the hands of individuals, and again that will have the direct impact on this investment and stock market. And sometimes tax reliefs, tax holidays, tax exemptions given to individuals and companies will see lot of money, lot of savings in the hands of individuals, and that savings in the hands of individual can be directed towards the various investment avenues, and that will see a prosperous or promising growth of stock market. Balance of payment. This it's a country's monetary receipts from and payments abroad. It may be surplus or deficit. Balance of payment is a measure of the strength of rupee on external account. If deficit increases, the rupee depreciates and it affects cost of imports. The volatility in stock exchange rate affects the foreign institutional investors who is keeping their money into Indian stock market. And monsoon and agriculture. This is an important and major factors which will affect the industry and allied sectors also. And there are many industries which are directly relied on monsoon and agriculture. So sugar industries, cotton and textiles industry, food processing industry, and good monsoon will lead to higher demand for input and results in bumper crop. And good monsoon again, it's an optimistic in the stock market or for the stock market. Infrastructure. How the infrastructure facilities available in the country will have the impact on movement of goods from one place to another, starting of industry in different regions, and it will ensure regional imbalances in the country. And again, it is a indirect force for creating jobs, and jobs will create more purchasing power. Therefore, communication system, regular supply of power, banking and financial sectors all will see a lot of positive impact on the stock market. Finally, demographic factors. Demographic, we mean it's a population by age, population by occupation, population by literacy, population by geographical location. One of the positive sign or positive factors that India enjoying is demographic dividend. India enjoys demographic dividends when compared to other countries. Indian economy remains young economy because more working population between 15 to 49 remain in India. That is why the MNCs are starting their own enterprises in India, because India is a labor intensive country. And this demographic dividend, more working population, will be a positive sign for as it results in national income. It will be reflected in gross domestic product, and therefore demographic factors also play a major role, and which will have the direct impact or direct bearing on the Indian stock market. With this, we will conclude the economic analysis. In the next video, we will see industrial analysis. Thank you for patient listening.